Looking at the modern market through two different lenses reveals two conflicting realities. On one side, broad indices show a smooth upward ascent. On the other, individual equities are defined by violent shifts and unpredictable volatility. The price-to-earnings or PE ratio sits at the center of this disconnect. It is the core metric of fundamental analysis, yet it remains one of the most frequently misunderstood numbers in finance. At its simplest, it is a tool for this constant balancing act, weighing the market price of an asset against its actual earnings power. But the meaning of that balance changes depending on the scale of the data. At the macro level of a whole index, a high PE functions as a low-yield forecast. But for an individual stock, that same high multiple shifts the nature of the investment into a bet on price momentum. To use this tool effectively, we have to deconstruct the fraction itself. By separating the price from the earnings, we can calibrate long-term expectations and apply the same valuation filters used by institutional managers. The difficulty begins when we apply index-level logic to individual stocks, a mismatch that often leads to a significant miscalculation of risk. On the macro side, the standard measurement is the cyclically adjusted price-to-earnings ratio, or CAPE. It measures market-wide valuation by averaging earnings over a 10-year cycle to account for short-term economic swings. Historically, a CAPE ratio of 27 has served as a warning sign. Crossing that threshold has often preceded periods of significant market overvaluation. This perspective is largely defined by the work of Robert Shiller, who used decades of market history to show how high multiples impact future returns. To build these 10-year averages, researchers pulled data stretching back to 1881. An era when the U.S. flag had only 38 stars, and the industrial landscape looked nothing like the modern economy. This deep history creates the anxiety of mean reversion. The logic is that if the long-term average CAPE is 16.8, then a market sitting at 30 requires a 20% price drop to return to its historical baseline. We have to determine if this reversion is a legitimate signal to exit the market, or if it's a statistical red herring. The ratio is determined by the independent movement of its numerator, price, and its denominator, earnings. Fear of a market crash assumes the only way to lower the ratio is a shrinking numerator, where the index price falls. But the math allows for a different outcome. If earnings grow while the price stays flat, the ratio still drops. The denominator catches up, and the valuation reverts without any loss of capital. Because CAPE uses a 10-year average, this often happens naturally. This older, recession-heavy years drop out of the look-back window, and are replaced by higher current profits. The denominator expands automatically. This is why professional investors often flip the fraction, looking at 1 divided by the CAPE. This shifts the focus away from a vague valuation number and toward the actual earnings yield. In this model, a CAPE of 30 represents an earnings yield of 3.33% above inflation. At the index level, a high multiple is less a signal of an inevitable crash, and more a forecast of lower yields for a longer period of time. Individual equities, however, operate under different constraints than a broad index. Research by Amin and Pandya highlights what happens when high entry multiples meet real-world business performance. Buying a single stock at a PE over 50 carries a heavy mathematical burden. To simply maintain its current price, the company must often double its net profit in a very short window. Take the case of Vodafone. Investors bought in at a PE of 75, but the business followed with negative growth. Because the earnings didn't expand to support the multiple, the stock price eroded 90%. Even moderate growth can result in a loss. Castrol grew profits by 6% annually, but because the entry PE was 52, the multiple contracted over time, leaving investors with a negative return despite the company's growth. Invest that with Reliance or TCS. These companies delivered massive returns because investors bought them at lower multiples, allowing the stock price to grow alongside the earnings rather than fighting against a shrinking ratio. When an investor pays these steep multiples, they are no longer relying on business growth for their returns. They are relying solely on the hope that someone else will pay an even higher price later. An individual stock's, a high PE, creates a hurdle rate for growth that very few businesses can ever actually clear. To manage this risk, institutional frameworks move away from absolute PE numbers. Instead, they use relative filters to establish a margin of safety based on a stock's own history. This table illustrates a mechanical decision-making framework. The key is comparing the current PE to the stock's own 5-year median. Following this filter, a PE of 20 can be a reason to reject a stock if it suggests the price has outpaced normal earnings power. Conversely, a PE of 25 can be an entry point if it represents a discount relative to history. The framework also sets a ceiling. When multiples reach 50 to 70, risk is flagged as high, regardless of history. This mechanical approach is a direct application of the principles established by Graham and Dodd, the fathers of value investing. By using a relative filter, the investor ensures they are paying for current, proven earnings power, rather than betting on an aggressive future growth forecast. These two concepts form a unified model for valuation. Index investors use the PE to manage their expected yield, while stock pickers use it to filter for outliers. For an index, the yield line provides a baseline for long-term allocation. It tells you what kind of return the current price is likely to provide over the next decade. For the stock picker, the relative filter identifies the safe entry zones, separating businesses with sustainable multiples from those that have entered a period of speculative pricing. A professional approach requires both sizing index exposure based on the macro yield and selecting individual stocks by their 5-year median. The PE ratio is not a single warning light. It is a measurement of resolution, telling you when to wait for a better yield and when to demand a higher margin of safety. Moving past the volatility of daily prices reveals the underlying relationship between the cost of an asset and the earnings it produces. The PE ratio functions as a hurdle rate. It defines exactly how much growth a business must generate to provide a return on the price you pay today. In a high multiple environment, the only protection against speculative risk is the discipline of the relative filter.